1. UK jobs market weakens, unemployment rises, interest rate cut likely. 2. UK jobless rate hits 4-year high, what it means for interest rates. 1. UK jobs market weakens, unemployment rises, interest rate cut likely. The UK job market is facing a tough patch, and the numbers tell a story of growing concern. Recent data reveals a sharp rise in unemployment to 4.7%, the highest level in 4 years, while job vacancies have been dwindling for 3 consecutive years. Analysts are now speculating that the Bank of England may slash interest rates in August, but this raises a critical question: should the central bank prioritize economic growth over still climbing inflation? Let's unpack the details. The Office for National Statistics, ONS, reports that pay growth slowed to 5% in the 3 months between March and May, a sign that wage pressures are easing. However, this slowdown hasn't translated into stability for workers. The government has called for going further to boost the economy, while the Conservatives have labelled the unemployment rise a disgrace. Meanwhile, Bank of England Governor Andrew Bailey hinted at the possibility of larger-than-expected rate cuts if the labour market continues to weaken, a move that could spark fierce debate among economists. Yad Al-Selfan, chief economist at KPMG UK, argues that the slowing pay growth opens the door for an interest rate cut in August. Most expect the bank to reduce rates from 4.25% to 4% at its next meeting. But here's where it gets controversial. Critics warn that cutting rates now could backfire if inflation remains stubbornly high. Is the Bank of England prioritizing short-term relief over long-term stability? Or is this the right move to prevent deeper job losses? For small businesses, the pain is already tangible. Peter Kinsella, who runs 2 Spanish restaurants in Liverpool, describes the current climate as the toughest since 2008. The recent hike in employer national insurance contributions, NSEs, has forced him to cut staffing hours, limit opening times, and delay repairs. "We're managing, but just barely," he admits. His reluctance to hire new staff mirrors a broader trend. HR Director Peter Wallerflynn reports a recruitment freeze across most of the 300 businesses he advises, with some companies resorting to redundancies or restructuring to survive. The ONS data paints a stark picture. Job vacancies have plummeted to 727,000 for the April-June period, the lowest in a decade, excluding pandemic-era lows. Payroll numbers have also dropped, with 68,000 fewer people on payrolls in March-May compared to earlier months. Paul Dales of Capital Economics notes that businesses are clearly reducing headcounts to offset rising costs. Political tensions are heating up too. Employment Minister Alison McGovern highlights efforts to tackle barriers to employment in economically inactive regions, while Labour's Helen Whately condemns the punishing government for yet more job losses. The Liberal Democrats demand the reversal of the NIC's tax, calling it a jobs tax stifling small businesses. But is this finger-pointing helping workers, or is it time to focus on solutions? And this is the part most people miss. The inactivity rate, the percentage of people not seeking work, has fallen slightly to 21%, but it's still higher than pre-pandemic levels. This suggests many remain sidelined from the labor force, raising the question: how can policymakers reignite participation without further burdening struggling employers? As the debate intensifies, one thing is clear: the UK labor market is at a crossroads. Will rate cuts stabilize the situation, or will they fuel inflation and deepen uncertainty? We'd love to hear your take. Do you think the Bank of England is on the right track, or is it risking a bigger crisis? Share your thoughts in the comments below. 2. UK jobless rate hits 4-year high, what it means for interest rates. Britain's worsening unemployment crisis just broke a 4-year record, and the fallout could change the economic rules of the game. But here's where it gets controversial. Some experts see this setback as increasing the chances for much-needed relief in the form of lower interest rates. What's really going on, and could it actually help you? According to new data from the Office for National Statistics, ONS, the UK's jobless rate has unexpectedly climbed from 4.6% to 4.7% over the 3 months to May. This rise, although seemingly slight, is significant because economists weren't betting on any change at all after last month's uptick. When statistics take such a surprising turn, it often signals deeper shifts happening beneath the surface. And this is the part most people miss. The ONS figures, while concerning in themselves, come with an important caveat. Participation rates in the job market remain lower than ideal, adding uncertainty to just how bad things actually are. Meanwhile, wage growth appears to be slowing down. Average weekly earnings grew by 5%, a step down from the 5.2% pace we saw recently. To put that in context, while it's still robust by historical standards, any slowdown here is closely watched by those making decisions at the Bank of England. Liz McEwen, the ONS's Director of Economic Statistics, sums it up. The labor market continues to weaken, with the number of employees on payroll falling again, though revised figures from tax data indicate the recent decline isn't quite as steep as earlier believed. Wages are still rising, just not as dramatically as before. Perhaps even more worrying, job vacancies, a crucial measure of the economy's underlying health, have been on a steady downward slide for 3 years straight. This ongoing drop means fewer opportunities for people looking for work, and it's a trend that's hard to ignore. But things are even more complicated. Right as these troubling employment numbers landed, the ONS also revealed a surprise jump in inflation to 3.6%. This surge, driven by rising fuel and food prices, muddies the waters for the Bank of England as it decides when or if to cut interest rates next. Traditionally, high inflation prompts central banks to keep rates high to keep prices in check, but the broader slowdown in economic activity is making that call tougher than ever. Most analysts still predict a quarter-point cut is on the table for the bank's next meeting in early August, which would bring the base rate down to 4%. Why? Simply put, the weakening job market is becoming impossible to overlook. Even Bank of England Governor Andrew Bailey recently hinted that softening employment conditions might be the crucial factor in decisions moving forward. Here's an often overlooked point: policymakers rely on weaker pay growth to help slow down the overall rise in prices. There's real concern that stubbornly high UK inflation is partly a result of wages rising faster than prices since August 2023. This wage-price dynamic can be tough to break and complicates any attempts to return inflation to the bank's 2% target. Add in recent data showing the economy shrinking for a second straight month, and it starts to look like the UK is edging towards stagflation, a rare and troubling mix of stagnant growth and stubborn inflation. For government officials, this combination is particularly unwelcome, as it puts them under tremendous pressure to get things moving in the right direction. But is fiscal policy making things worse? Some think so. On Wednesday, Chancellor Rachel Reeves faced criticism for new employment taxes introduced in April. Industry groups, particularly in the grocery sector, argue these extra costs are being passed on to consumers as higher food prices. There's also a suggestion that higher minimum wage requirements are putting additional pressure on both employers and shoppers. At the same time, these changes appear to be slowing down hiring. Take the Frasers Group, which owns Sports Direct. The company just reported a £50 million increase in budget-related costs, and it's now turning to artificial intelligence to help offset some of these financial hits. Even with all the headwinds, one small ray of hope for Chancellor Reeves is the potential for lower interest rates next month. If the Bank of England goes ahead with the expected rate cut, it could ease the government's borrowing costs, a key concern, especially as she faces shrinking flexibility in public finances due to recent policy U-turns on winter fuel payments and welfare reforms. The pressure is mounting to find ways to balance the books, with further tax hikes or spending cuts possibly lurking in the autumn budget. KPMG UK's chief economist, Yadel Selfin, believes the case for a rate cut is now stronger than ever, pointing to the obvious slowdown in both the labor market and wage inflation. In her view, the bank may need to act quickly to head off deeper economic pain. With domestic activity remaining sluggish, the Bank of England's Monetary Policy Committee will likely want to provide support through looser policy before things get worse, she explains. Here's the bottom line: the UK stands at a crossroads, with rising unemployment, slowing wage growth, and persistent inflation creating a tricky puzzle for both central bankers and government officials. Is cutting rates the right move, or could it fuel even more inflation down the road? And do tax and spend policies help or hurt at a moment like this? This is where your perspective matters. Do you think lower interest rates will really help the average person, or could they make things worse in the long run? Are government policies supporting workers or just adding new burdens? Share your thoughts below, and don't be afraid to disagree, because the debate over Britain's economic future is only getting started.